All right, good morning, and thanks for joining us today. We're going to get started for the very first session in our four-part series today. We're focused on transaction service basics for business owners, and it's hosted by the Michigan Manufacturers Association and the closely held business experts at Clayton and McCurvey. We've seen a dramatic increase in business sales and succession recently. Some of that's simply demographic. There are over 3 million businesses run by baby boomers that are looking to exit in the next 5 to 10 years. And the pandemic has certainly accelerated that interest. So I'm very excited to hear today from 3 advisors at the top of their field with some tips on how to get things in order well in advance of any transaction. My name is Delaney McKinley, and I'm Vice President of Membership Marketing and Events for the Michigan Manufacturers Association. MMA is the only statewide organization focused solely on securing a prosperous future for Michigan manufacturers. We do that through effective advocacy, meaningful education, and strategic business services. We represent nearly 1,700 members, ranging from small mom and pop shops to the world's largest and most iconic operations. Facilitating today's discussion will be Jim Beal, a shareholder with Clayton and McCurvey. He's the firm's leader of their manufacturing and distribution team. Jim manages a portfolio of closely held businesses. He provides guidance on tax, finance, operational, and accounting issues that impact his clients' bottom line. And he's known for his energetic approach, so I know that this morning's discussion is going to be especially engaging. Now, before we get things rolling, I've got a little bit of housekeeping to cover. We hope that today's discussion will be interactive, so please feel free to use the Q&A function to share your thoughts and questions for Jim, Tim, and Margaret. Now, if you're familiar with Zoom, you will know that if you hover towards the bottom of your screen, there should be a taskbar, and within there's a button that you can click on that says Q&A, and it'll open a separate window where you can enter your questions. Also on that taskbar is a chat function. So if you're having any technical issues, you can enter them there. And then lastly, after today's session, we will be sending you a recording of the discussion as well as the slides that are being shared today. So watch your inbox for that within the next 24 hours. Now, we have a fantastic panel of professionals participating in what we expect to be a dynamic discussion this morning. So without further ado, I will hand it over to you, Jim. Good morning.
Thanks, Delaney. Excited for today's session. I think it's a topic that is of interest to every business owner that I talk to. So it's an area that we run across quite a bit. As Delaney had mentioned, that we niched our practice to closely held businesses, the majority of which are manufacturing or distribution concerns. So as we're out in the practice, as we're looking at what's happening out in the marketplace, yes, we are seeing, as Delaney also mentioned, a significant increase in the M&A activity. So it's, again, a variety of reasons why this is occurring, but there's a common theme that we see as practitioners that we're out there, and that theme is a lack of knowledge relative to the full transaction process as you're either buying or selling a business. So today's overview session is the first of a 4-part series, which is listed on the screen. It's going to occur over May and June, that we're going to present through the MMA on basically transaction basics, transaction service basics for business owners. So the idea is to help guide and educate. You can attend all 4, you can attend individual ones, but the idea is to educate so that whether you attend one or all 4, you're going to have a better knowledge base to be able to position yourself on the inputs that drive value in a transaction if you're selling or buying. So we're excited to go through this. And I've got a couple speakers here today that I work with closely in any situation where I have a manufacturing client that is in an M&A activity. I will pull in these 2 individuals, and I've worked with them closely. The first is Tim Hilligus. Tim is a transaction specialist that manages a portfolio of closely held businesses. Tim is involved in a majority of our firm transactions. He was recently recognized by the Association for Corporate Growth as a advisor of the year on the Sanders Candy deal that occurred. Looking forward to hearing about Tim's presentation today. Second is Margaret Amsden. Margaret is a shareholder in the firm's private client services practice. Her focus is individual estate succession planning strategies and entity structuring. She interprets tax legislation, working proactively with clients to realize the best possible advantage again, most of the transactions that go through our office go through Margaret as well. So work closely with both Tim and Margaret, and please, by all means, fire your questions out. We'll monitor those as Tim's going to kick off the presentation. I'll turn it over to Tim to start it out.
Thanks, Jim. Appreciate it. Good morning, everyone. You know, this is an interesting topic. Over the years, Margaret and I have worked on many transactions, and we've tried to take some of this information and bring it out to the market to educate companies like yourselves. It's difficult to market hey, you want to sell your company, come to our webinar or come to our seminar. And usually people don't show up because they don't necessarily want anybody to know they might be thinking about selling their business. So probably about 5 years ago, we started having this dialogue about you're not for sale, but how can you be more prepared for when that opportunity comes? And that's kind of the foundation for this. So we're going to scratch the surface on many things. So hopefully you'll have some questions for Margaret and Jim and myself, and we're happy to answer those. And Margaret and Jim may interrupt me depending on the questions and the area that we're at, but we're going to cover kind of a broad base spectrum of the kind of the buckets that you need to be focusing on as you consider not only just possibly selling, but considering getting your business ready for any type of exit or transition, whether it be internal or external. So you know, the questions you ask, I think will probably be questions that other people have. So I always like to encourage participants, don't be afraid to jump out there with that first question, and we'll hopefully be able to answer anything you guys send our way. All right. Now, there we go. So as I said before, key takeaways from this discussion is a basic understanding of a sale transaction, understanding the various areas between accounting, legal, tax, HR, the structure of your business. All those things may play a role in the efficiency, the smoothness, may limit the fatigue. If you've ever heard that term, there's a lot of what they call deal fatigue in the transaction world. And a lot of that comes from the complexity of the process of due diligence and so forth, and the energy that goes into all the participants in a transaction. So what are we talking about here? You're not for sale, but, well, the most common thing that Jim and Margaret and I see are probably two different things. And I categorize them as the phone rings or the door, somebody knocks on the door. The phone rings, that's the private equity, the family office, the investment banker. These are cold calling, finding out if you're interested. Maybe they've got a customer of theirs that's looking to add into their portfolio of companies, or have an add-on into the structure of their organization. And they're looking nationally for companies like yours to try to integrate into their operations. And so, you know, you're getting those phone calls. You know, what do you do? There might be points where you just say, I'm not interested. And maybe there's a point where you go, well, maybe I want to go one step further. But we hear this every day. And Margaret and Jim and I will get phone calls from clients going, I got a guy who wants to look at my business. What do I do next? And we can start walking them through that process. And the other way, equally as common, is that succession planning. Everybody mentioned before, we work with closely held businesses. Many of those could be first, second, or third generational families. And so you might be looking for a generational transition. And that's a good time to start talking about some of these same issues that we talk about in the transaction world, selling externally versus selling internally. What are some of the things to consider? Making sure the value is assessed correctly. Maybe you've got key employees or management that you're interested in bringing into the equity, or possibly even transitioning completely. And of course, there's the traditional buy-sell agreements you might have with your existing partners or shareholders, managing liability protection, and looking at possibly estate and gift planning. So those are all important components that we think this kind of framework or this initial discussion will help you kind of get your arms around what are some of the things maybe you should be thinking about. So I wanted to show you a typical deal, just so you get an understanding for those of you who haven't really been through this process, and maybe the only information you have is what you hear from friends or peers, or maybe club members or golf partners or something. So this is kind of a timeline. You know, I think most transactions, in my experience, usually from start to finish, in a market where you are for sale, probably takes 6 to 8 months. That's probably the norm. And certainly there are issues that might make a transaction go longer. And hopefully some of the things we talked about this morning will make your transaction, if you were to incur one or go down that path, maybe even shrink it up a little bit. But probably the critical areas from our perspective are that planning. What are the things that you as a company could have or initiate from this conversation to try to get your business better suited for any type of transaction? Again, that phone call or knock on the door. And sometimes they go quickly. I know Jim's got a client who wasn't for sale, and all of a sudden, an LOI shows up. It was very unusual, but to realize that those opportunities might be knocking on your door or calling on your phone, kind of getting an idea of what these steps are. And we're going to talk mostly about kind of the preparation. What are the things that you can be thinking about or consciously reviewing to get yourself better ready? And I'll mention the Morley Sanders deal that Jim mentioned. That was probably a 10-year process where we started talking to them about improving their balance sheet, improving their cash flow, improving their ownership structure, improving their employee contracts and their equity plans, and trying to engage key executives so that a buyer knew key executives were going to stick around. So that was like a 10-year process working with them. They were never for sale in that process till all of a sudden, again, that phone rang. And it was a legitimate opportunity, and thankfully they were ready to move when that happened. They had put some of these steps in place starting over 10 years ago. So let me share with you some key terminology that I think is going to be important for you to understand with respect to transactions. There's the enterprise value. There's typically the two ways that a business might be bought, asset or stock, and then there's kind of a hybrid. When most transactions take place, they're considered cash-free and debt-free, and usually you're only selling the operating assets, and you would retain your non-operating assets. Non-operating assets might be, maybe you've got a country club membership equity. I have a client that has a condominium that's really not performing, but it was just something back in the day when they started their company. That's where their cash was, and they put their kind of a board of directors condo on their balance sheet. More often than not, it's a related party activity. It's shareholder loans, or maybe you've got a building and you've lent money to that. And so those would be considered non-operating assets. So that enterprise value, that's kind of an important component. That's the thing that really sets, like, am I ready to sell? If that number gets big enough, but it really encompasses the value of your company is based on many other factors. And one of the things that Jim and Margaret and I face is, I'll call it water cooler talk. That's probably not the right terminology. It's probably golf course talk, whatever it might be. Maybe even MMA talk, where you find out, well, so-and-so sold their business and they got this or they got that. And there are so many components that go into that enterprise value: the value of your customers, the diversity of your customers, the diversity of your management team, the strength of your balance sheet, the strength of your vendor agreements and things like that. So, every deal is different. People can give you some generalities, but your company and its strength in the areas we're going to talk about today will really determine, where would your enterprise value be compared to somebody else. And I think it's important to realize that when a valuation specialist or an investment banker or somebody gives you a value of your business, it's important to understand that when they're talking about that number, it's what are all the things that come with that. And that's going to be your fixed assets and your net working capital, your personal property and your net working capital. Net working capital is basically, if I was thinking about a car analogy, and you looked at two cars that look identical from the outside, and you say, well, what's the difference? Why is this one 80,000 and this one 60,000? Well, it's when you look inside and you say, well, this one's got cloth, this one's got leather, this one has cruise control, this one doesn't, this one's self-driving, this one's not. So those are things that affect that net working capital and the equipment and the value of employees and your customers really can affect the enterprise value significantly. So I'm going to, because I can't see, I'm going to ask Jim and Margaret if there's any questions at this point.
Tim, no, there's no questions that are coming up.
Okay, so great. So these are the terminologies, and again, as I said, this is really what you're selling, and this is the area that the value of these components, the net working capital, fixed assets, your workforce in place, your customer and vendor contracts, and we call it going concern or goodwill, the cash flow. This is what somebody's buying, and this is what their due diligence process is going to go through when somebody's considering buying your business, you're considering selling your business. These are the things you want to make sure you have as perfect as you can be, or as good as you can be with respect to being ready to sell for the best price you can get.
Tim, is the net working capital just your receivables and inventory less payables and accrued expenses? Is that what and how you operate your business over a period of time? What specifically is the net working capital?
Yeah, so that's pretty close, and we'll have a slide where we'll actually show everybody what net working capital looks like. On its simplest form, it's your current assets and current liabilities. These are operating assets. So you're absolutely right, Jim. Accounts receivable, inventory. For a lot of the viewers today, it's going to be work in process, projects in process, might be prepaid expenses. Some of the items that get a little trickier on the liability side are going to be maybe customer deposits or billings in excess of costs and profits, where you've got that liability sitting there to kind of close up a job. And depending on the terms of the transaction, things like customer deposits can be treated differently than traditional, like a traditional accounts payable or a liability that might be inherited by the buyer. But yeah, that's kind of it. And the reason it's important, Jim, and I'm presuming that everybody online is similar to our client base. They're closely held, and we're going to talk. I've got another slide where we talk about this specifically, but a lot of them run their business the best way they want to run their business, and sometimes that might be they pay bills early. It might be that they carry customers who maybe are slower payers because they have a longer term relationship with them. So they may carry excess inventory. We have a steel distributor, steel servicing center, that for their convenience has just carried excess steel. And you're going to say, well, what's the big deal about that? Well, when the time comes to sell your business, if a buyer presumes they get all that excess, that's a significant reduction in the return on investment you're going to get. And so you've got to navigate, is it easier to try to bring those inventory levels down and put them more in the norm of our industry? Or do you keep them at an excess level and make sure that anybody that buys your company understands, hey, we believe we have excess inventory and we're expecting to get compensated as a part of that enterprise value that you're offering me. So there's a lot of nuances within the net working capital that are critical to especially companies who run the business the way they want to run it. So let's talk about, we're having this discussion, what type of advisors and who should you be thinking about getting involved in this? Of course, as accountants, we usually have probably of this group, probably the most interaction, except for maybe internal management within our clients. When I think about the touches that we have because of financial statements, tax returns, things like that. And if you think about the last few years between PPP loans and the employee retention credits, I mean, there's just a lot of reasons that we've been in our clients' faces over the last few years. But this is kind of your team here. These are the key people to make sure you make those introductions and you get the right people involved in this. And they all have a factor. They all play I think a critical factor in not just the efficiencies, but picking the right team or having the right team on board. You want advocacies. You want advocates for your business and for your transaction. And there's times where a lot of people will be advocates for the deal itself, and maybe that's the right spot for them to be. But making sure you have a team that is your company's advocates is going to be important, and frankly has some experience with transaction work. Margaret and I have seen on a few occasions where we've had either to supplement someone else's transaction because maybe the tax analysis or the tax needs on a transaction weren't there. Maybe the legal needs weren't there because you've had a long-term corporate single shingle attorney, and he doesn't have that bench strength of an M&A attorney. You know, I mean, Jim brought it up for our firm. If Jim has a client that's looking at a transaction, he's calling myself, Margaret, Ben Smith, you know, somebody on our team to kind of come in. So hopefully within your network or within your organization, or reaching out to these people on this list, you're finding the right people to be on your advisory team. So let's talk about some of the specific considerations that you might want to have right now with respect to getting your company in tip-top shape. You know, we call it, you're getting it to be your Sunday best. You always want to have your Sunday best. And it's not unusual for clients within our firm to not be 100% on GAAP accounting. You know, very often they have a period 12 or December adjustments, could be accruing bonuses in a good year, could be accruing profit sharing in a good year. It could be managing, for example, the PPP loan treatment. And so it's not unusual for us to have clients who are not on GAAP financials every month of every year. And so, you know, understanding that a buyer is going to be looking at probably 24 to 36 months worth of accounting information, understanding where you have those GAAP departures or where you have differences in accounting is going to be important. Because while we all may have differences in our financial statements with respect to generally accepted accounting principles, understanding how buyers might value those or think of them as less valuable is going to be is really important. And so when we get together with clients and we start talking about, hey, what would happen if we did the due diligence on your company? What would we notice was different within your monthly financial statements? And what might we modify or consider modifying now to get you more in tune with GAAP, or continue with your current process, but at least identify it and then consider maybe an internal report that might modify what you're showing on your external reports, that might modify it. For example, maybe you start accruing some your commissions or other profit sharing or bonuses or things like that. Maybe you start normalizing those over a period of time on internal statements, as opposed to those you might give to your bank, where you're trying to show your best profit until you get to that point where you know exactly what you're going to do, possibly for profit sharing or bonuses or something like that. Obviously, reviewing the quality of earnings and looking for adjustments, one-time adjustments. These are things, you know, it's not unusual for us. PPP, for example, would be a one-time adjustment. Professional fees for a specific issue. Maybe you had an audit, a federal audit or a state audit, and so your professional fees spiked up in a certain period in this 24 to 36 months. Those are the types of things you would normalize when you're thinking about, you know, what your net income is that you might report on your financial statements. And the third thing there, the net working capital. I kind of talked briefly about the challenges of having excesses, and excesses to me are twofold: inventory and those companies here that might pay their bills early to take advantage of maybe some discounts. When you're doing that, you know, the buyer wouldn't know any differently, but if they looked at a working capital where you're paying your bills down outside the norm or inside the norm of your industry, they might presume that that's the balance sheet they're going to inherit. And so understanding that if you're paying bills early and being able to normalize that is going to be important for you getting the most value out of your balance sheet. Again, that balance sheet comes with the sale. And so making sure that wherever that's measured, and we'll talk in a minute about the balance sheet and the net working capital, it's really going to be really important that you get the value for that. So those are the primary considerations. So let's talk a little bit about quality of earnings. I mentioned before, in the current situation, PPP would be one. Unusual and non-recurring items. Related party transactions in our practice is probably the most common. This could be excess compensation for owners or family members. It could be no compensation for family members or owners where there should be compensation. So an adjustment possibly in another direction. And the next slide, I'll kind of show you where you might have or how you might see CPA firm prepare a simple quality of earnings report for you to let a potential buyer know what's your true cash flow. We call it normalized or adjusted. And errors, could be issues related to accounting errors that really occurred in a prior period, but were recorded in the period that might be under due diligence. So you want to make sure you identify those one-time type items. So here's kind of
Tim,
yeah.
Tim, real quick, you might want to just take a second. I know a lot of people, when you say quality of earnings, may not really understand the importance of quality of earnings and what exactly that. Why do we care? What does that mean?
Yeah.
What does it measure, and how is it used?
Sure.
Because until people realize that it's kind of the basis for the enterprise value, it's hard to really digest the importance of what you're talking about.
Yeah. So with this slide and with Margaret's comment, this might be one of the most important things you can do with respect to getting the right understanding. First of all, what is the right value for your business? And number two, where does this number put you, in kind of the general framework of where your enterprise value would be? Because enterprise value is a function of this bottom line, this adjusted EBITDA that you see on the screen. And that is kind of, the higher that is, usually the higher the multiples are, but there's other factors, obviously customer mix and management team and things like that. But this really becomes your Sunday best. This is the one that says, and I'll tell you that even within our clients, sometimes things happen that you prefer wouldn't. But look at the EBITDA reported for these three examples here. And look at the differences between the adjustments, and these are legitimate arm's length adjustments. So for those people watching, imagine that somebody's valuing your company on the reported EBITDA line, the 589,000, the 800,000, and the 442, because you've signed a confidentiality agreement and you handed them your financial statements. And this happens very often. And so all of a sudden they've got that information. And I will tell you the Margaret, Jim, myself, our ears perk up. The minute we know a client's done that, we're like, whoa, let's be careful, because if they use that information to give you a letter of intent that has an offer price, it's going to be wrong. And it's not going to be probably where it should be. And just using these examples here, if your company is a 6 multiple, your EBITDA and the market conditions and the going rate is 6 times your adjusted EBITDA, that $400,000 adjustment would be $2.4 million more of value that a potential buyer would be able to identify and recognize in their letter of intent. So I think it's really important to understand, while this may seem very simple and rudimentary, what we do when we do this by 24 months. And so we'll do to the most recent 2 years, and usually the most recent trailing 24 months. So if we're in June, or right now we're in May, we'd be using April 2021 back 24 months, but we'd also be working on the calendar years 2020 and 2019 to lay this out so that a potential buyer has a adjusted understanding of what the real cash flow for this business is. So
Tim, one other thing, I guess when I've been working with Tim, we get clients that get very excited, want to give the information out, want to give the EBITDA reported versus the EBITDA adjusted, because they just want to get numbers out there. And it paints them in a corner, because once the price is out there, you have an uphill battle to try to counter it. And then on top of it, if there's surprises in the numbers, whether it be a positive or negative normalizing adjustment, you have issues, because it undercuts the confidence of the buyer in what they're looking at. So it has a negative impact. So we really advise the clients to slow down on the delivery of the information until we can at least get a look at it first.
Mm-hmm. And I have clients who at this level can do this internally, and very often will. They'll understand what their market rent is. They'll understand that they're overpaid, and they might be overpaid so that they can maximize their retirement contributions or profit sharing components. But and it's not unusual for our clients to have In some cases, extreme excesses of meals and entertainment. Obviously there's tax ramifications to those, but a lot of our clients belong to country clubs and utilize those benefits to entertain their employees and entertain their customers and vendors. And so, when we look through those things, we can normalize them with the industry trends and look at peer or same size enterprises and kind of get an idea of, well, where do things look unusual? And even with our own clients, I mean, that's where the experience comes from within our own clients, where we know what to look for when we're trying to put something like this together. But this gives you a really good idea of why knowing what your true adjusted quality of earnings is important. And the reason I like this kind of schedule is most of our clients who are entrepreneurs really spend more time on their profit and loss than they do on their balance sheet. So it's usually easier for them to relate to this type of schedule to see, oh, yeah, my financial statements showed 442, but I got $400,000 of discretionary components or adjustments in there. And my real cash flow is 842,000. So usually this is easy easier to kind of get our clients thinking about what's their true operating income. And again, probably one of the most important components. This to me is like the window sticker on my car analogy. This tells the buyer what they're really getting in very great detail. So, we talked about, and I think in the next few series, you're going to talk to other professionals and they might get into more details. But one of the things an investment banker often does is put together what they call a confidential memo about your business. It's just enough information to let everybody know what they'd be buying and what, little history and understanding of your business. And very often that book that they hand over to potential buyers will have this report in there. And it's probably the most important page that most people go to understand what am I getting for my money? What's the cash flow I'm going to get? So that's a major component to understanding the value of your business. The second one is net working capital. And I've talked about quite a few of these. Really important to understand if your balance sheet is not in the norms for your industry, whether on purpose or not on purpose. And, again, I use the examples of carrying excess inventory or paying your payables down. It's important to understand that just like the last slide where we talked about, enterprise value is how they put that big number in your letter of intent. They're also going to be looking at a big number as to what do they get? What are the underlying performing assets that we get for this business? And we spend as much time analyzing that because it's important they call it a PEG number. What is the net working capital that I get for my business? So you offer me, $24 million for my company, but we expect you to provide us, in this example, $1.9 million of working capital. So this is a working capital example that we've kind of, made, took an actual example and obviously made it confidential. So it's just kind of generic, but you get an idea of this would be the second, probably most important report within that information you would hand off to a potential buyer. And what this does is it identifies, what are the normal components of net working capital that the buyer would expect to get. And as you can see, I don't know if you guys can see my mouse when I move it, but Margaret, can you see my mouse when I move it on the screen? Yeah. So this bottom line gives you kind of an idea of this is the trailing 12-month average. So what net working capital is it's current assets less current liabilities with some adjustments for cash and other items that might be, I mentioned customer deposits, personal tax liabilities for the seller. Those would be scrubbed out of there. And then you get an adjusted net working capital. And so you can see in this example for this business, their receivables go up, their payables go down, that the net working capital is a moving target. And what this analysis does is it kind of gives us an idea of, are you a cyclical business? If not, then maybe you just use this trailing 12-month average. So at December 31st, this company's trailing 12-month average was 1,877,000. If they were to have sold their business on December, they would have conveyed 1,863,000 to the buyer and might owe the buyer $14,000 less in purchase price. But this is an important component, because you may have a buyer who comes in and says, well, we want $2.5 million of working capital. And if you haven't gone through this analysis, and I just picked that number, but here's the highest number. So you get a buyer that says, well, we think the business should come with $2.5 million worth of working capital, accounts receivable, inventory, less accounts payable, and accrued expenses. And you look at a schedule like this and go, well, wait a minute, that was an unusual period that came out of a high sales month where our receivables went way up, and we bought a lot of inventory, and our inventory's way up, and we paid, we used our line of credit or used our debt service to help pay that. We can't we're not going to give 2.5 million, and so that's where having a schedule like this, if we can use or agree on the trailing 12 months average of 1,877,000, where your buyer comes in and wanted 2.5, that's over a $600,000, $650,000 price difference that you'd be negotiating with your buyer. And the other reason this is important is, let's say in your industry, the norm for inventory is, we don't have obviously a sales report here, but let's say in this example, the normal inventory is 800,000 for this size company. And you can look, this company is always above that. And so you got to look at two things. Number one, do they have obsolescence in there they've never written off? And number two, are they just carrying more than they need to because it's convenient? They don't want to wait for stuff. And so when cash flow is good, interest rates are low, we're just going to carry more inventory. Well, again, that inflates this number, that inflates this trailing 12 months. And so making sure that you've identified situations where your balance sheet has grown inadvertently. And again, speaking of our examples within our client base, a lot of our clients don't follow or focus on the balance sheet as much as they do the profitability and the profit and loss statement. So, this could be an eye opener for what your net working capital actually looks like. And by the way, within your trusted advisory group, this is where you got to make sure you all understand and don't get surprised. Do you have bad receivables? Do you have bad inventory? Those are important things to identify early on in this process. Any comments, Margaret?
No, it always surprises me how much the net working capital can change, especially in some of the examples with closely held companies where, we have a lot of owners who are, they don't like debt. They don't carry big lines of credit, and they pay their payables as soon as they're due. And as a result, they can, very quickly overstate the way a third-party financial buyer would run the business and leverage the business, and maybe not get paid as much as they should just because of their habits.
Mm-hmm.
So Margaret, in that scenario, if they paid their payables immediately because they like to pay them, and they're down 200,000 in payables, they've just lost $200,000 in sale price, is what you're saying, because of their methodology. The owner or the buyer is expecting that is a standard process that they have to do with their vendors to continue the business and maintain the profitability that they've historically had.
Yeah. And that's one of the reasons why we always say that, you're not for sale, but you need to think about what would the net working capital or your quality of earnings look like to a buyer. And because buyers generally are going to look at a trailing 12 months when they're doing their net working capital, you want to start adjusting your business operations so that when a buyer comes in, the trailing 12 months really represents what you would normally operate a business on, as opposed to having to prove to them that the adjustments are right.
Mm-hmm.
The question for the two of you relative to the net working capital, a lot of the letter of intents that I see, the LOIs, we'll say net working capital to be negotiated, or to be the net working capital peg will be determined at a later date. That always is not being in the transaction world. And when I talk to owners, they get a little nervous about that. Maybe you can speak to that as to that. Why is that customary that way?
Well, I think the main reason it's customary is because it is such a substantially negotiated item in the purchase. It's one of those things. I don't want to presume that people have maybe well, they always have their own self-interest, but the scenario starts with, we valued your business based on the EBITDA you told us, and we'll figure out the net working capital later. Don't worry, we'll agree to that. We'll agree to that. And you can see in the example that's on the screen, you can see the various differences between, the low of $1.2 million and the high of 2.5. That's a pretty substantial negotiation that, if it was just, it would be like, imagine that you've got an offer for 24 million and somebody offers you 25, that's substantial. And it's the same thing here. So Jim, my experience is they put that off because they're waiting for the seller to get tired very often. And maybe the seller's not as educated about their balance sheet as they are in their P&L. Margaret brought up the point of, when you're making these decisions because it's how you run your business, what Clayton McCurvey does, let's say that phone does ring for one of our clients and we haven't had the 12 months or the 24 months to kind of say, hey, start paying your payables on time instead of early. Let's bring down your excess inventory, right? We don't want to just give that away, because Margaret's absolutely right. It's easier to, there's no argument on an actual balance sheet that is within the norms of your industry. You get pessimism and you get more subjective analysis when we decide, well, we didn't have enough time, we weren't for sale, but yeah, we're carrying an extra 500,000 of inventory. We're paying our payables down. And so we're going to stop doing that when we sell this to you. So we would start making adjustments in that lower section there. And we would make adjustments within our client's balance sheet to make sure they didn't lose any money. But Jim, Margaret and I have seen this go to 11 p.m. the night before closing, where a private equity firm gets everybody on the phone and goes, we still think our net working capital peg is just, we're missing something here. And we've heard our clients, because they were tired, just say, well, let's raise the peg $500,000. That's $500,000 at 11 p.m. the night before a closing that they just gave the buyer, versus saying, this schedule kind of speaks for itself. This schedule tells us what it should be, or within reason. And by the way, selling your business is not a science. This is an art. And so there is the give and take. When you set this average, there's going to be the flow of operations. But the idea behind saying that I'm going to give you $1,877,000 in net working capital when I sell you my company, what that's protecting you as the seller is, what if I had a great December and my AR went up $1 million? I get paid for that because we set this mark at $1,877,000. And if another $1 million of receivables were sitting there, there'd be $2.8 million of net working capital, and I'd get my money for that big sales month I had. So that's why this is as equally as important as the enterprise value and the letter of intent offer that comes with it. So really two important components.
Yeah. Now, that said, oftentimes the buyer is going to want to push the net working capital to the end because they're waiting for all the due diligence to get done. And they want to see, are there any accruals that maybe the buyer or the seller should have been booking that they haven't, so they can take that into consideration in the net working capital. And they are waiting for deal fatigue to kick in, because there is a point at which they're going to start asking for stuff and the seller just wants to get to close because it's been dragging on for 6 months and people give things away at the last minute. So the best answer is, when they're asking for things at the last minute, just be quiet. Don't say anything.
Yeah. So here's kind of in summary, what are some key things that we think when you're a closely held business and you make your own decisions every day that you should be aware of when they might affect your quality of earnings and your net working capital and your fixed assets. So again, Jim and I have an example right now. A client was not for sale, has invested millions of dollars in new technology to take their business into a new industry. And, imagine that if he's for sale, maybe he doesn't quite take that step, because every $1 million he spends in R&D might cost him $8 million of value at an enterprise level, where a buyer wouldn't consider that, worth a legitimate adjustment. So I think it's important to understand that when you're analyzing your business and you're investing in opportunities, where are those and how do I quantify them? What are some of those conveniences that owners have and we need to adjust in quality of earnings? And on the net working capital side, I think we've kind of hammered this home. Watch out for excess inventory. Watch out for slow paying customers that might be discounted or diluted by a buyer, and then paying your payables faster than terms. Those are all things that might take money out of your pocket. And the last one, we'll talk a little bit about COVID towards the end, but fixed assets. I mean, it's not unusual for anybody to continue to buy the property, plant, and equipment they need to run their business on a day-to-day basis, and all of a sudden go into sale mode and go, uh-oh, fixed assets go with that enterprise value. What do? I just bought this. Well, we have an example. I got an LOI yesterday where we put an adjustment in there for some equipment we just bought. The buyer's going to get 100% of the benefit and the use of that. We weren't for sale. Everybody nodded their head yes, but it had to be identified. And it's important to know that when you're building with fixed assets, or you're acquiring fixed assets, those need to be identified as either a special circumstance, or they're just going to get thrown in the bucket of fixed assets and be part of your enterprise value. And we wouldn't want you to possibly miss an opportunity to get reimbursed for those if the buyer's going to get a substantial benefit from that new equipment. One of the other tracks that we wanted to just mention is understand that your contracts play a major role in the due diligence for a buyer, and understanding the considerations within those contracts and how they might have an impact on a buyer, whether your contracts with your customers, your vendors, your landlord, they might have change of control provisions. So somebody comes in and buys your company, is your lease now broken? Is your purchase order with GM, Ford, or Chrysler non-transferable or broken? Do you have some vendor contracts that help you commoditize some of your raw materials? And so now could those be broken, or they have to approve them, or they're, and so all of a sudden you're trying to close and sell your business kind of free of anybody else's input but your own. And you find out that, no, one of my customers has a clause in there that says we have to approve who buys you. And that actually happened in the Sanders transaction, where we had some major customers that we had to get permission from. And it was fine. They understood that now they want to know who the buyer is. They want to understand the future of the business. But the reason that Margaret and Jim and I bring this up is the next time you have a contract coming up for renewal, maybe you just say, well, I'll just sign this because it'll be the same as the last one. But maybe have your attorney read it and say, you know what, if I was thinking about transitioning my business, is there anything in here that would create anything other than a notification? You don't want to have any kind of provisions in your contracts that will put you in a spot where you cannot easily go through a transaction without getting all kinds of permission. So that's one of the first things that Morley started to do early on, was within their contracts. And they have I don't want to say hundreds of contracts, but a lot of contracts within their organization, and making sure we watch for these types of clauses was important. The HR side, I can't say enough about trying to lock key people up, whether you're considering a management equity plan or non-compete agreements. Do you already have contracts in place, and do they have provisions for change of control? So identifying those. On the due diligence side, I think Jim was a longtime participant in our 401k plan audits for our clients with over 100 or over 120 employees. It's important to understand almost all of those have errors. And so making sure you're mitigating those when those errors occur, it'll just take one of those due diligence potential contingencies off the table when that time comes. Margaret and I have encouraged management equity plans, which keep key people tied into your company right up through a closing, right up through a sale. And that can be both in a written plan where they actually gain actual equity, either with a time vesting or a performance vesting, or it can be phantom equity where it only occurs on an actual sale of the business. or change of control. So there's a lot of ways that you can identify and lock up, and that's probably not the right way to say it, but I think really put the right people, make sure the key people that made your business successful and will be critical to a buyer are in place through a transition. It's really important. So those are kind of my tracks. I'm going to turn it over to Margaret right now, and Margaret's going to talk a little bit about the structuring of your organization, because let's face it, when most of you set up your companies, it wasn't thinking necessarily probably about how you were going to exit or how somebody might buy you. So our clients face this in some way at some point. So I'm going to hand it over to Margaret.
Thanks, Tim. So there's a lot of reasons that you may want to do some pre-transaction restructuring. There may be some things that you want to do after. Sometimes the restructuring is suggested by the buyer. But the ultimate goal behind all of it is flexibility. Flexibility for you in terms of maximizing your after-tax proceeds, flexibility from a buyer in terms of maximizing any tax benefits that they get out of it. You also want to make sure that you're taking into consideration some of the legal issues, specifically around, for example, the transferability of contracts and the importance of your federal tax ID number. So right now, if you look at your entity type, you might be a partnership, you might be an S corporation, you might be a C corporation. Each one of those comes with their own restrictions. Partnerships being the most flexible, C corps and S corps. S corps are actually less flexible because there are a lot of requirements with regard to who a permissible owner is, what happens if an impermissible owner comes in, and the requirement that everything be handled on a pro rata basis. Sometimes people are looking at selling assets because they figure, well, I'll just sell all my assets and then I can deal with my own entity. I don't have to worry about it. Buyers oftentimes like that option in that they don't have any of the legal history of the entity to deal with. On the other hand, if all of your contracts are tied to your federal ID number, even though trying to sell the existing entity may have limitations to it, the buyer really needs your federal tax ID number. So how do you take that into consideration? You also have to think about, you've been living your life with a non-cash asset, and you're going to convert that over to a position where you have a lot of liquidity now. So should you be taking into consideration things like charitable giving? Should you be taking into consideration things like estate planning? We've got a lot of clients who have always talked about gifting to their kids or, putting money aside for charity, but I'll do that later. Right now, I'm just operating my business. Well, all of a sudden this opportunity comes up and the question is, how do I do those? And spending time thinking about what your long-term objective is and putting some of those things into place now can be really helpful. The other thing to take into consideration is that oftentimes your buyer is a private equity or some kind of financial buyer, especially in the current environment. And if you are selling in that kind of a transaction, they frequently want you to roll over a part of your investment. So maybe I've got a company, it's worth $20 million, and they say, we want you to roll over 20% or 10% of your investment, right? Or 20% of your investment. Well, that rollover can be tax-free if we structure it right. So having a conversation in advance of the knock on the door or the phone ringing to talk about where you're at, what are the benefits of where you are now, what could you do a little bit differently to make sure that you're in a good place for a transaction if and when one comes up, can be really helpful. Can you flip to the next slide, Tim? The other thing to think about is there's this thing called a tax-free reorganization. So if you're an S corporation and your buyer can't buy S corporation stock without having a bad event, you can do something called an F reorganization. If you're a partnership, you can oftentimes put a new parent LLC over your existing entity. Those are two ways where your federal tax ID number stays in place. And it's something you can do today so that you're in a good position. It's not unusual that we have clients who are going through that reorganization at the same time they're going through a sale. And so what ends up happening is there's this whole extra set of documents and this whole extra set of coordination that needs to happen at the same time you're selling your business. So doing that kind of a tax-free reorganization in advance can make life a little bit easier. If, on the other hand, you have an entity where, maybe you've got some substantial assets in it that you don't want to sell, or that a buyer is not going to buy, the condominium, for example, that Tim brought up earlier, that may be a situation where you take your existing business and you push all the operating assets down into another entity. But again, all of this is around flexibility for you as the seller, flexibility for the buyer, what's going to get everybody to the best tax answer and keep the most cash in everybody's pocket. It can be scary, but it doesn't have to be. But it is something that the sooner you think about it, the better off you are in terms of being prepared for the transaction that's coming up.
Yeah, I agree with you, Margaret. When you think about it, a lot of those happen right within the sale process and within purchase agreement discussions and negotiations. So what I would encourage the viewers is, if this isn't coming up, should you raise your hand and say, is there any way that a reorganization might have a better result for me tax-wise, or for my rollover tax-wise? And don't presume that everybody's thought through all these things, because maybe they haven't experienced as many of these types of circumstances where reorganizations occur, like for example, that we've seen within our client base. So great, thank you.
Yep.
So kind of just in wrapping up, what do we talk about? There's the different tracks within a due diligence process that we think you should be looking at with respect to your operations. We talked about the EBITDA and the quality of earnings. We talked about your balance sheet and the net working capital. We talked about the fact that your key people are going to be critical to a due diligence review. And of course, your legal documents and contracts. Obviously, there's other components that we don't generally get involved, the human resource aspect of it, the actual operations of the business. So, making sure you've got the right team involved in that's going to be important as well. And getting that team, we talked about, having the right people involved, and making sure that, the sooner you start having this dialogue with your trusted advisors, the better result you're going to frankly have. And it doesn't always happen that way, but to be honest, we've seen clients where we've flipped on a dime. We've got in there and been able to kind of backpedal a little bit and say, wait a minute, they don't have enough information. We need to get this potential buyer more information. So all the things we talked about today, we know the sooner you do them, the better. But certainly these are things that if your phone is ringing and you're already under maybe a confidentiality agreement, that there's steps you can take to move this more in your favor than not. I'm going to kind of go through past our propaganda there and turn it over to Delaney.
Thanks, Tim. Well, first of all, I'd really like to thank all of our panelists today, Jim Beal, Tim Hilligus, and Margaret Ansden. Some really fantastic information, really invaluable insights for folks who may not even quite be thinking about what the future may be holding. So it's important to be thinking about it today. To our participants, we encourage you to reach out to any one of us with your thoughts, questions, or just to chat and brainstorm. I hope you'll also save the date and plan to attend the 2021 Manufacturing Operations Conference. And we're holding that on May 19th, both in person here in Lansing and via live stream. We'll have nearly a dozen professionals helping to tackle some of the biggest challenges facing the manufacturing industry, talent, Industry 4.0, and more. You can find out more at mimfg.org. Both Clayton and McCurvey and MMA have a vast array of resources available to support Michigan manufacturers as we respond to and recover from the pandemic. So be sure to check out our websites, claytonmccurvey.com and mimfg.org. So thanks again to all of our panelists, and I hope you all have a wonderful day.